gentlemen, welcome to the Josh Line Podcast, brought to you by Velocity Lending.
That was really good.
I really liked that voice, like coming in there out of nowhere.
Yeah, I did too.
I think we should do that every single time.
Lord.
Dad?
What's up, everybody? Dakota Burke here from Velocity Lending, along with the man, the myth, the legend, Josh Lyon, and we are here talking some mortgage tips today on our podcast. So, Josh, one of the big things that's been coming up a lot lately is seller concessions. What people can do with them. Can they use them to buy their interest rate down? Can they use them to cover closing costs? So, what are all the things that seller concessions can be used for?
I love how you answered that question yourself. I love it. So for what people, if you don't know what seller concessions is, it's when the seller gives a specific dollar amount to the buyer. It could come up where, hey, they needed a new refrigerator or, roof or something along those lines, or they just put it in the offer as well.
And a lot of times it used to happen at inspection, not necessarily at the offer, right?
Correct,
yeah.
Correct. And in what we're seeing a lot is like the 2110 buy downs, which we use seller concessions to cover. So they are requesting those up front. One thing with seller concessions, going into it, is the home does have to appraise at it. So if it's $440 as a purchase price and you offer $450 with $10,000 in concessions, it does have to appraise that $450 mark.
Yeah.
But seller concessions, you can pretty much use them for anything but the down payment. Mm-hmm. You can't use it as if you're putting 5% down. It can't help cover that 5%. But you could use it for the 2110, 321 buy downs, which we see more and more now, to help cover closing costs. So if you had, if you're doing a $400,000 loan at 3% down and you have that $12,000, but you don't have that stuff to cover closing costs, you can use that concession to cover closing costs and just bring that out of your pocket.
Yeah. What about for loans that are 0% down? Could you potentially buy a home with zero money down?
You could, yep. So you can use the seller concessions to cover that. So I know we're going to talk about USDA here in a little bit, mm-hmm. but yeah, if you're doing a VA or USDA and it's 0% down, you are going to, you can literally get into a home for no money out of your pocket.
Yeah, which is amazing. And it's a great segue into USDA, one of the loan products we wanted to talk about right now. So USDA, everybody kind of knows, is a rural housing loan. Up here in northern Colorado, where kind of some of the places that people can look at if they are looking into a USDA loan?
So there's a website. You can go to the website. We always get that. But I mean, pretty much anywhere east of I-25 that's not Greeley, Evans, you can do USDA. There's a small portion of Johnstown, like where I live, you can't do USDA. Mm-hmm. I can't remember, and I'm not even going to say it because I did look up the number of what the population had to be. Because I do feel that possibly Windsor's we're getting bigger.
Right.
But I think we still got plenty of room to keep Windsor in USDA territory. But it's a phenomenal program. That's 0% down. Doesn't mean there's not closing costs, because there is a difference between your closing costs and your down payment. Mm-hmm. And what's also nice with it is your mortgage insurance, which they don't call mortgage insurance, but it's less than most of the times conventional, and it's less than FHA.
Right, so your payment ends up being a lot less. Why do you think is it because of the rural part of it that people don't usually try to go for it, or why do you think that that people don't try to do the 0% down as often?
Well, I do believe USDA, in my opinion, is one of the best programs out there, but it's also one of the most difficult to qualify for.
For sure.
So when you're looking at a USDA, you're looking at the debt to income ratio. Typically a back end's 41%. I won't get into all that works, but for comparison's sake, FHA can go up to 57%. Mm-hmm. So that's a big difference there. It's a lot more difficult to qualify because you do have your income caps as well. But if you can fit in that bucket and you can find that property, I know we've saved people $400 or $500 a month doing USDA comparative to Chaffa.
Yeah.
When they found that perfect property for themselves.
Yeah, absolutely. And finding a rural property just may end up just taking a little bit more time than, say, because there's not as many homes available, but it's just like taking the time. And like you said, if you're saving $300, $400 a month, why not take the extra month or two to try to find a property?
Correct. Yeah. And if you're little strapped for cash, same mm-hmm. thing, because it will behoove you later down the road than doing a Chaffa loan or things like that, because it will put you in a better financial position.
For sure, absolutely. Another thing that's been getting brought up a lot lately is the difference between like the down payment, the closing costs, prepaid items, that sort of thing. I feel like we've been explaining that a lot more lately than we have in the past. What are closing costs? What are they used for?
Well, I don't want to say we haven't explained them as much as in the past because we explain to everyone. I don't. We go over the loan program. Like kind of how we work is we bring you in for a meeting. We go over the whole shebang so you understand it and are comfortable with it, not just say, hey, here's your loan estimate. I think it's just becoming a lot more prevalent because they're getting more expensive.
Yeah.
Appraisals have gone up. Credit reports have gone up. Taxes are going up.
Third party fees like title.
Fees, everything is getting, I mean, we've seen ridiculous amount of inflation over the last year and a half. So that's trickled into our world as well. So I think, I mean, the big thing people should know is there's your down payment, which can go from 0% down to 5% down as far as your minimums go, or more depending upon if you're doing non-QM loans, but we won't get into that. But just knowing what that closing cost number can be, I think is very pertinent to folks, because it can average from $5,000 to $12,000. We just don't know because a big chunk of your closing costs are your prepaids.
Right.
And
prepaids being your homeowner's insurance and your property taxes.
Right. So when we close on a home, we have to collect a year in advance of homeowner's insurance. Plus we collect another 3 months into your escrow account. So that alone, if you're looking at $200 a month, you're looking at, well, let's say 24, about $3,000 out of your pocket just for insurance.
Well, and then just the difference is, if somebody's comparing like, oh, well, I only had X amount in closing costs, and why are yours so high? Well, your homeowner's insurance is $350 a month because you're buying a, much more expensive home.
And this is going to lead into people who are shopping.
Yeah. We
get all the time, well, they're giving me a better interest rate. Okay, well, let's actually break it down and see if they are giving you a better interest rate. One, they could be charging you points. Points are you spending money to buy your interest rate down. Well, their closing costs are better. Well, they're only collecting 3 months of taxes, and we're collecting 8, and your taxes are $500 a month. Right,
and that's not determined by the lender how much they're collecting for taxes. That's based on the county. So it's going to be the same no matter what lender you go with.
When you, at the end of the day, when you go to close, the closing costs will roughly be the same. Once you take out Section A and Section B. Like if they're charging an origination fee or for points, there's going to be a big difference there.
Yeah.
I mean, some appraisals, you can find them $100 difference at places. It's not that big of a deal. But I mean, your big thing is what are they charging in Section A is going to be your difference, because we do our best to always be upfront and transparent and give you the most accurate numbers possible. But I've definitely seen loan estimates that aren't even remotely accurate, where they may not even have an escrow account collected.
Right.
I mean, I've seen them off thousands, like $5,000, $6,000, $8,000 less than what they should be.
Right. Or we've even seen one where the lender's charging people points and they didn't even know it.
Right.
It's like, oh, they're giving me a better interest rate. Like, yes, but you're paying $8,000 to get this interest rate.
And one thing too I want to touch on is the new builds and in metro taxes. So with your new builds and your metro taxes, your taxes are going to be roughly double what they would be for an existing property. And I've seen on a new build in the last 6 months where the other lender was charging them $47 a month for taxes.
Because that's the land values taxes.
Their taxes were $480 a month.
Right.
And so when they closed, because they didn't want to go through the process and like verify, hey, X, Y, and Z, and they can make these payments for a year, but when that escrow shortage comes out and they're $5,000 short plus they got to pay, that monthly payment's gonna go up by $700.
Oh, easily, yeah, if not more.
So it's not just, I kind of went on a tangent here, but it's not just about, hey, what's your interest rate? And here's the thing, right? You can go take it to 150 different people, and we could be the best one day, things so on and so forth. Someone might be better than us. But one thing I can guarantee you is we're going to take care of you, and we're going to give you the best customer service possible, and we're going to get you to the finish line. I think it's like 67% of transactions. I'm not sure they don't close or have hiccups, something along those lines. I don't want to put it out there exactly. But we take pride in what we do, getting people to the finish line, giving them the best care that we can. And we do a lot of work up front to make sure we're going to have zero to very little issues in the back end. We always want to do our due diligence with folks. And that could take an extra day or two.
Yeah.
But I'm willing to do that and maybe lose a deal here and there to make sure that I'm giving you the best service I can and not just saying, hey, we're going to throw it against the wall and see what sticks.
Right. Absolutely. Yeah. And doing that up front does take a little bit more time, but it saves you time on the back end too. So it's more, so you're spending more time like figuring out, like moving and that sort of thing. So you don't have to worry about like, oh, what does a lender need to get? What do I need to get the lender for their documents?
And then for our realtors too, it's then they know that they're trusting us with their commission. They're trusting us with their paycheck, right? It's not just, hey, this is a lead column. This is your paycheck. This is your livelihood. So when we send out a pre-approval, we want to make sure, hey, that thing's good as gold. and you're going to qualify, and you're not just driving around and showing people properties for no reason and wasting gas.
100%
time.
Absolutely. Well, everybody, I think that's about all the time we have for today on our podcast. If always, you need to get a new loan pre-approval going, just have any questions about lending, or just want to chat with Josh or myself, give us a call at 970-460-6677, or reach out to us at our website at.
Also, this will come out a ways after, but if you want to just call and chat about the Nugs, we're super stoked.
Oh, yeah.
Go Nugs.
Go Nuggets.
I'm sure we'll see Mike Malone and Greeley here shortly. So,
Absolutely.
the website's nocolending.com. So thank you so much for watching, Mom and Leah. I appreciate y'all.
See you guys.